little bit later today, our next guest says that the drama, this is, I'll read it anyway, the drama at the meeting won't come from the decision itself since it's 99% that they're not going to do anything. But obviously it's going to be from the Fed's forecast. Let's bring in Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. Maybe if I were to write that intro, Kelsey, your take is that they're done. The last one, the last hike was the final. The last one they did was the last one.
Yeah, that's correct. So we don't expect there's going to be a lot of surprises around the decision itself. We know that they are going to stay on hold, but really everyone is going to be focused on what they are going to project for next year. And there's two key things that we think the Fed is paying attention to right now. It's one, the fact that inflation is falling faster than they originally anticipated, and this is very good news. On the other hand, they have to weigh the fact that growth has been coming in a little bit hotter than expectations. But when you weigh those two things together, what we think they are really focused on is the fact that inflation is coming down faster, and is also the fact that job growth is moderating. Because it's not all about the level. It's also about the speed of deceleration. And what we've seen over the last 6 months, we've seen job growth slow from 300,000 to 150,000. And we've seen inflation, core CPI, 3-month run rate, slow from 5% to 2.4%. I think that's plenty of progress to keep them on hold and for them to be comfortable saying that this is where we should be staying for a while.
So Rorschach, though, for people like you and economists, other people thought that that there were some troubling details in the two recent inflation reports in terms of core and everything else. And then you add in crude and where we might be a month or 2, 3 months from now, as that, it's not in the core, but it certainly can seep into the core. Those, you've been saying this for a while, that inflation is that the Fed's doing a better job of harnessing that than a lot of people think. And you still think that. Shelter too, Kelsey? Or?
Correct. So shelter is going to be the category that we think is going to drive the disinflation going forward. So that rate on shelter has come down from increasing at a 9% clip to a 5% clip, and we think that's going to slow even more. But you do bring up a good point in terms of gasoline. Gasoline prices are on the rise, and that is creating a wrinkle for central bankers. But when we look at the move in gasoline prices, there's a couple things we're thinking about. One, it's not just about the impact on inflation, it's also the impact on the consumers. We view this increase in gasoline as a tax on the consumer, on a consumer that's already squeezed. So that negative growth effect from higher gasoline prices, I think, is a bigger factor than the increase in the headline inflation that you're going to see. Now, the other thing to note is that in the energy inflation basket, there's two portions. There's commodities and there's services. The commodities portion, that's the gasoline. On the other hand, that's services, that's natural gas. Natural gas prices are actually 70% lower than last year. So the impact on the headline CPI calculation is going to be somewhat cushioned by that fact. And I think the last thing that we do want to think about is what is driving this increase in oil prices? Is it demand or is it supply? Because the differentiation between those two is really important for economists and central bankers. We think it's primarily being driven by supply, not by a resilient global economy. And again, for that reason, we're more focused on the downside growth impacts of higher gasoline rather than the upside inflation impacts.
Because that's something, that exact point was something I've asked just about every person we've had on. What does higher oil price, is that a global tax that can dampen global growth, or does it seep into the inflation of it, and which is a more powerful dynamic? You think that it's deflationary more than inflationary. That's interesting. Why would the Fed, and you think that they will continue to forecast cuts next year, or you think that those won't come out for 2024? Other people we've had on have said that where we are, 5% plus on Fed funds, that's where we were before the financial crisis. So we've normalized rates. Why would they, if they orchestrate a soft landing, which is a big if, why would they cut next year?
Right. So I think the soft landing is still a big if, right? I don't think we should be assuming it's a given. In fact, we see a lot of leading indicators that suggest the risk of hard landing and recession is still very elevated. But regardless of soft landing or hard landing, typically what the Fed does is they pause for a period of time and then they fine-tune policy. If you go back to 1995, which was the soft landing example that everyone likes to look at, they did cut rates briefly before assessing the landscape and then having to hike again. Now, what we think that the Fed is going to signal is that rate cuts are appropriate next year because inflation is going to be falling. And as a result, the real policy rate or the inflation adjusted policy rate is going to be passively getting tighter unless they do something about it, unless they cut. So even if we don't see a recession next year, I think they still are going to be in their minds expecting rate cuts. And that's, again, to keep the real policy rate at a steady, restrictive level around 2% real.